And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow.
Hello, everyone. Welcome to this week's Wealth Within Update. I am Jim Beach, and joining me, as always, is Dale Gillham. You can find out more about him at wealthwithin.us. He is also the author of the book, Accelerate Your Wealth. It's your money, your choice. Dale, great to talk to you. I feel like a big yo-yo. How are you doing this week?
Yeah, it's a bit like that, isn't it? When you see these sort of unprecedented events happening. And I think, we do need to separate the two between the market and obviously the coronavirus. To me, that's two separate things, but we're fine. To me, I went shopping on the weekend, everything else. I just can't find toilet paper at the moment because everybody keeps stocking up on it. And I heard one of the supermarket chains said that they'd sold 18 months of toilet paper in 2 weeks. How's that?
So
buy shares in toilet paper companies.
Yes. Why do people stock? I mean, why is that what people crave to go buy during a storm? I just don't get it. I don't understand why we are stockpiling it now, but I will admit this. We have about 4 months supply in the house right now. So, it's one of the things I bought, but I bought it because I knew all of the other morons were going to go buy it. All of us lemmings. So anyway, and I've been out and about too. I just was telling you, I spent the last 4 days down at Universal Studios and Disney World in Florida with my 4 children and my wife. We had an amazing time. One article sort of summarized that I saw on Drudge while I was down there surfing while I was in line. It said, if I'm going to die, let it happen at Disney World. So anyway, but you know what? I'll tell you this. We do plan to spend the next 2 weeks at home. My wife is not working. The kids are home. We're not playing with kids on the street for the next 2 weeks. I'm not going out for the next 2 weeks. I think almost all of America is shutting down right now, and we're done. We're not going out unless we absolutely have to.
Yeah, I think a lot of places like that. I know the New Zealand Prime Minister shut the borders over the weekend, saying anybody coming into New Zealand would have to go into self-imposed 14-day isolation. Our Australian Prime Minister came out last night and said the same thing. So as of today, anybody getting off a plane or a boat will be going into isolation. Even though we haven't been as affected, anywhere near as affected as other places in the world, it does pay to be safe and be careful, and obviously use the hand sanitizer and wash your hands as much as you can. But again, in terms of the economic effect, there's still a lot of conjecture about the economic effect of what's happening with world markets, etc. So, but it is quite an interesting time, and I think we need to not just get used to it, but always be in the back of our mind that things like this could happen again, because we're now a much more connected world, not just technology connected, but also in terms of travel. I've still got travel plans. I'm still coming to the US in about 4 months, maybe. And I'm still going to Europe in about 8 weeks. So I think I'm not going to worry too much about it.
Well, hopefully in 8 weeks, the worst will have passed and we will feel safe again. And, I will tell you this, my wife and I used this opportunity to buy tickets to the Cayman Islands for June. So we're hoping that we can travel by then. And we got a great rate on it and paid the travel insurance in case we have to cancel. So anyway.
I'm definitely with you.
Well, I hope you join us in the Caymans. We got a nice place for you. All right, let's talk about the market. 2 of the biggest drops ever, 2 of the biggest jump climbs ever. Again, I feel like a 500-pound yo-yo. I don't like it. I don't like feeling like a yo-yo.
Neither do I, and it's we do get times of increased volatility in the market, and then volatility drops away. But when you get different events, like tsunamis, or you get things like 9/11, or you get, bushfires, or whatever they may be. They cause volatility to increase depending on the severity of whatever that event is. And you do get markets move because of events, and you also get economic things as well, like economic slowdowns will move a market as well, or an economy moving faster will push the market through to new highs. And so we need to isolate this to say, well, right now there's a specific event that was not predictable in terms of the veracity and what's happening, when we need to deal with that. But two of the largest point falls on the Dow since 1900 happened last week, and that was the 9th of March, where it fell 1,141 points, and the 11th of March it fell 1,051 points. And yesterday I was looking at all the daily data of the Dow, trying to get information on that, to what was actually going on with the Dow, and it was just surprising to me seeing those two big falls. But I will come back with you with more information on that over the coming weeks anyway.
All right. So is it now a buying opportunity? Are we there yet?
No, to me it's not a buying opportunity. I know we chatted about this a couple of weeks ago about Buffett, saying sometimes he sits on his hands, because I said I was sitting on my hands at the moment, and that's what I'm still doing. It's a lot of people. I've been getting a lot of emails, a lot of people commenting on our YouTube channel. Now, at the end of our chat, I'm going to be looking at the Dow and really showing people what I think the Dow is going to do over the next few weeks. But right now really is the time to not try and bottom pick or catch falling knives. And people are saying, why, things are really, really cheap. And, when you're looking at the market, it can seem to be cheap, or some of those stocks can seem to be cheap. So stocks that were doing very, very well have fallen. Some of them have fallen very heavily, some of them not so much. Like Microsoft's hardly fallen a lot. Apple hasn't fallen too much, and there's quite a few other companies that haven't fallen too much over the period of the last couple of weeks. So they're being more resilient. But now is really the time to sit back and watch, because what the market's likely to do is it will bounce. All markets bounce. All markets will test previous highs. But what they also do is quite often go down into a zigzag. So they'll come down, they'll bounce a bit, and then they'll fall away again. And that's really what we need to be concerned about at the moment, is making sure that if it does bounce, we don't jump too early.
Right. So I just heard that that the Fed has reduced interest rates to 0. That has come out. There was, a bill somewhat passed. Maybe it's going to get through the Senate. I think will be the next step on Monday or Tuesday. I don't know exactly when, to hopefully have an $800 billion stimulus package that seems to be attracting, bilateral support. Do you think that these are the actions that are going to give us a relatively calm Monday, Tuesday?
Well, I hope so. I think, we're getting, over the last couple of weeks, we've had a lot of irrational heads, because it hasn't been predictable what happened, or in that such a fall. When we're looking at the Dow, if we go back to the 1929 crash, the Dow took over 36 days to fall 25+%. We've done it in 14 days right now. So we're talking about twice the speed. If we go back to 1987, you're looking at the fall in 1987 for the Dow was, I think, a lot longer than that. Actually, I can't remember the exact number of days, but a lot longer than that. It was about like 40 or 50 days. Even in the GFC, when we had a financial system meltdown with the GFC, when we had banks closing and the financial whole world was in flux, and it took 90 something days for the Dow to fall 25%. So these sorts of things, something's moving it, and I was only saying the other day to somebody, there's something else moving this market as well. It's not just the coronavirus, because the US economy, as we've talked about several times, was traveling beautifully up until the last few weeks. It was doing very, very nice. So whether that's the algorithmic trading, whether that's those high frequency trading, whether it's a lot of mum and dads getting out of exchange traded funds, which we've talked about before, a lot of mum and dads panicking, possibly pulling out of those managed funds or those ETFs. It could be all sorts of manner of things that have been going on at the marketplace at the moment. But right now, it really is having a stimulus package is fantastic, and I know we've launched one here in Australia, but helping small businesses, small to medium businesses employ most of the people. There's a lot of casual workers out there in restaurants, coffee shops. These are the businesses we need to support, because when things get going again, you still want to go back and get that coffee. You still want to go to the local restaurant. But if they can't survive for the next 2 months, then they're all going to close. And when will they come back again? Yes, eventually. But I think we do need to support some of the big companies like your Apples, your Microsofts, your Hewlett Packards, all of those big companies. They can sustain this for a few months and not be too worried about it. But the smaller end of town, hopefully the rescue package is helping those out.
Well, I hope so. I have to think that if I'm a small business and I owe rent, I have to think if I go to my landlord with a little bit of honesty and say, hey, I'm in the boat with everybody else and I can't make rent this month, but you know what? I'm going to in 3 months when all of this is better, or you can close me down now. I have to think that we're in this together, and that the world, the country, the city, the dude next door will have the decency to just sort of say, you know what, I'm Citibank and I'm not collecting or holding you accountable this month. I don't know, Dale, am I crazy to hope that even the big players will do this? I mean, that's what we all have to do. We all just have to bend and let everyone have a little bit extra time, and we'll get through it and work together. My goodness, Citibank and Bank of America and every other company has to say, yes, we're in this, and we're going to continue to pay our employees as well as we can, like Disney announced. I heard Disney did announce that. And we're not going to get really mad if you don't make your payments this month.
Fantastic. We do need that. I totally 100% agree with you. It is a world thing, not just an isolated thing in a town. And obviously the business owners, it's not their fault for the situation. And obviously, to me, the landlords really do need to do their part in this. And I mean, like I know in Australia, we only had bushfires, 4 weeks ago or 8 weeks ago, we had massive bushfires and everybody was helping everybody and raising money. I know California's had the same thing in recent times with the big fires, and everybody came out to help everybody else. But now I'm seeing on the television people fighting over toilet paper, and I'm thinking, how times change, and we can't be doing that. We need to be helping everybody else. We need to be helping the elderly. They're the ones most susceptible to this virus, and also very young people. Get out and help the elderly, bring them food, help them out, help them get toilet rolls, but also with your businesses, your small businesses are going to get the economy moving again, and they really are getting out and about. And so to me, when the panic happens, stops happening, and things start to get back to normal, get out there and support people. Get out there and support your local Italian restaurant or your local Chinese restaurant, and show them that you do care. And I think really do, as human beings, we need to do that. And so I 100% agree with you, mate.
Yeah. Well, Dale, let's wrap this up, and I will get off my soapbox. So to wrap up our financial discussion, we're not going to catch any falling knives. When are you going to let us know when the knife is ready to catch? Is that right?
Yeah, I'll let you know when I think the market stopped falling. And I'm doing a lot more research at the moment just to make sure I'm a little more solid, but I do expect a bounce. And so it wouldn't surprise me if next week we're saying the Dow's up and everything's looking a little bit better, but then that's not going to be the signal. The signal's not going to happen for probably 4 to 8 weeks for me to really go, yes, now I'm comfortable. And so please, if you're watching this, don't jump early. Don't think you're picking up stuff cheap, because if you're looking for a bargain, you could actually get far more than you actually bargained for. That's my last words.
Okay, but I want to add on to my last words. Yeah. One of the things I've come to really love about you, Dale, is your passion for stock market history. And that's one of the things I've enjoyed so much about our little weekly chat is every week I learn a little nugget of what happened in 1929, the number of weeks it took then, right? So we've acknowledged in this talk that this is happening at a dramatically faster rate than anything else, than all of the other falls. Is it possible that your 6 to 8 weeks that historically leads you to believe that could really be 6 to 8 days?
Yep, Absolutely. There's no
Okay.
reason why it couldn't be, because obviously when you see a big fall, a lot of what's happening is hedge funds or short sellers are pushing the market down because they're selling stocks in order to profit. But when the short sellers, as you saw with Tesla, when they're getting out, they're pushing it the other way just as fast to close out their position. So for those who don't understand what shorting is, you're actually selling a stock you don't own to buy it back later, to pay back who you borrowed that stock from. And so that's really what happens. So if those people shorting the market over the last 2 weeks, they're going to need to buy the stock back that they've shorted.
Right.
And when they do that, that can accelerate the buying on the stocks and see the reverse happen, where the market rises very, very strongly. But I don't think that's going to be enough at this point in time. I want to see a lot more solid news around that saying, hey, we're not going into a recession, or we might only have less than 0.5% reduction over the next couple of quarters, and then we'll be bullish again after that, and then we'll get earnings growth after that, because that really is more about the medium to longer term. So to me, investors should always be looking medium to longer term, 18 months plus when they're investing. But right now, just sit back, take it easy, go and have a cup of tea and put your feet up.
And make sure you watch the rest of Dale's market updates that follow this video. Dale, I look forward to talking to you again next week. Everyone go to wealthwithin.us, and I pray for everyone's safe next week. Godspeed.
You take care, Jim.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Well, let's get into the Dow Jones. And as Jim and I were chatting about, the market has been a hell of a lot like a yo-yo. So today what I wanted to do is actually share with you some of what I actually talked with Jim, so you can actually see what happened in 1929 and 1987, and we'll compare it to today, and you can see what I was actually talking about. But on your screen right now is our Dow Jones, and it's the same chart that I've been looking at every week, and you can see, if I expand all of that up, you can see the last 2 months. So it's a monthly chart at this point in time, and you can see here, if I drop it down to the weekly time frame, you can see here, if I move that now, that's just the percentages. So from that high there on the week of the 14th of February, we've had 1, 2, 3, 4 weeks down to that low, where the Dow closed there at 23,185.62. So whilst it was down 28.5%, which is technically a crash, it finished up down around about 21% as of Friday. But let's go and have a look now. We go all the way back to 1929. So if you go right back here, where are we? 1929. So here's 1929 that we're seeing here. So this is the big move all the way down to 1932. So you can see there, that's July 1932, where the Dow was at 40 points, and that's what it hit, guys. That was a 90% fall in the Dow. So if you calculate from that high, there at 386.1 point, it fell 90% in price. Now if we expand that up, and you can see here, this is the weekly chart. So let's use the same price measure tool, and let's go down 20%. So we're here around 21%. 1, 2, 3, 4, 5, 6 and a bit weeks there to get to that. So if I go down to a daily chart, which we should be able to see, I'm just checking where we are on the daily chart. There we go. You can see here is the 29 crash, and so it didn't get down to that 20+%. If I put another tool on, it'll actually show you the time here, where it is. Time price measure, there we go. So here's the high there to this day here, which went down 20%. You can see 37 daily bars. So that's trading days, not calendar days. Calendar days are 7 days in a week. This is trading days. This is the actual days the market actually traded. So it was 37 days the market actually traded. If we now go up to, let's go back to weekly again, and we go to 1987. Where is it? 1987. There he goes. There's 1987. So we're looking at that move in 1987. You can see the big move didn't happen for quite a number of weeks. So if I use my little tool here, and we go to this, I go click on that, and I can see here how this bar here is that's 17% range, and it was 8 weekly bars. So it wasn't until it got all the way down onto this bar. Now we're looking at 20 odd % here onto that bar. So here we're on the Dow Jones. It took 8 weeks for it to get down to that point. And that's what I'm saying is there's a lot of difference between what happened then and what actually happened now. These crashes at 1929, 1987 and the GFC were all triggered by the financial world and the financial world's market melting down because of over leveraging and a lot of leverage trading or of borrowed money. So people borrowing a lot of money. We saw that in the GFC where a lot of people were borrowing money out of their houses, pumping it into managed funds, pumping it into stocks. We saw that a lot right through the US. Obviously, it's the start of it was the junk bonds, basically the subprime mortgage market. But there was a lot of borrowing going into the Dow and the S&P, and that's really why they crashed. But you can see the difference between now and then, and this is really why an event like this or the market moving like this really is really unprecedented how fast it's gone and how deep it's gone and so quick. Markets generally will tell us that they're going to fall away. They'll give us plenty of signals that they're falling away, like the GFC. I was picking that months and months and months earlier that I thought we were going to go into a large fall because it was so easy to see. This one's been out of left field. So again, what do I think's happening? So let's go now down back to the monthly chart and we'll come and have a look at the Dow again, more current, back to our current data. Right now the Dow's holding up a little bit. I think at this point in time the close is right down here. I think the Dow has a possibility to get below that 27,744. We will get a bit of a bounce. I'm not sure whether it's going to be this week or next week, but it will happen very, very soon. You will get a bounce. But we need to be careful because it's possible the Dow could fall down to that 18,000 point level. Now, nothing huge to worry about from where it's currently sitting at. We're talking that there is another 22%. That would be my absolute outside target for the fall. So that would be a 40 to 50% fall in the Dow if it did fall that way. I'm thinking this sort of level here around this would pick it up if it does fall away. So I'm thinking this sort of level here at another 10%, making it roughly 30% pullback or crash from the Dow, if you like. That's if it does fall back down to that. So that's what I was saying to Jim, don't buy early. Right now we need to sit on our hands. If it does bounce, and if the bounce is only short in time and price, then we might see another fall away or another washout, because we do see people coming in bottom picking, trying to pick up bargains, and then what you see is that move up again. So that's what I'm saying to Jim, it was down, up, and then down again. So I need to be prepared for that. As a trader, I need to be prepared for that. I'm just warning you that that's possibly going to happen or could happen, and that's why I'm saying don't jump in too early. But let's now get into the questions that you have for me for this week. Now, the first question I've got is from Sam Bordis. He says, "Hi Dale, thanks for your insight on these testy times. I'm a 19-year-old and looking to start investing into the stock market. I was wondering if I could get your opinion on Uber. There are so many mixed reviews about this stock." Yeah, they are. My plan is to invest in this stock for the long term. I understand that it is currently in a downward trend and was wondering if you think it might reverse or if it's rubbish. Thanks again, Sam. The couple of questions on Uber is really the big questions that people talking about on Uber is it doesn't make money. It hasn't made money in its whole history. That said, 2/3 of its divisions, or let's say there's 3 divisions of Uber, some of its divisions are making money. It's the ride sharing part that's not making money, but they do expect it to make money in the next year. But then those figures I was seeing before this coronavirus outbreak. So, I mean, I'm assuming there's a hell of a lot of people traveling with Uber, a hell of a lot less over the last couple of weeks, and possibly in the next couple of weeks as the US is in a lockdown and obviously the rest of the world's going into voluntary 14 days, not going anywhere, doing everything. Now, for most of us like me, it doesn't matter where I work. I can work anywhere in the world. As long as I've got the internet, I'm fine. And you know, to me, some people do have to go to work and some people will be self-quarantining. But right now, is Uber a good buy? Let's go and have a look at the chart to see from a technical perspective. So from a fundamental perspective, it's not making money. It's possibly not likely to make money in the near-term future. So therefore, it's probably way too early to buy from a fundamental type of perspective. But long-term, could be a different prospect, and this is really where picking the right time to buy is essential in terms of when you're starting out your portfolio. But again, I'd be looking at what you're actually doing, not just looking at one stock just because you like that stock. Maybe because you travel with Uber, you might want to buy it. It's like people buying Apple because they like Apple. Or Apple products. So on the chart, have a look at that. Uber's a newer stock on the marketplace. They rang the bell in the US stock exchange back here in early last year. Now, it went up for a little bit. This suggests they've floated and that the owners have taken out a lot of money and obviously realised a lot of their investing, which is great. But the market hasn't really liked it, and it's been quite bearish. I mean, even up to last in February, whilst it was good, it still closed lower in February. And this high here, you can see here, was in the 14th of February, roughly when the market, or the US market, or the Dow Jones actually started to fall away. So quite heavy. Right now it's way too early to get into this stock at this point in time, but really look at stocks that, look at big stocks. So what I would suggest you to do, if just quoting like in the Dow Jones, if you look at the Dow Jones Industrial Average and you look at all the stocks, there's 30 stocks in there, I think 31 stocks in the Dow. When you look at that, nearly 45% of the stocks in the Dow over the last 2 weeks have fallen less than the Dow itself, and fallen less than the S&P 500. So that's the big thing there. And looking at some of those stocks, and I did mention some of those with Jim, like Apple and Microsoft. I think it was Home Depot as well as one of those, and a few others. When you're looking at the big stocks, and it's the same on the Australian market for us, if you're looking at setting up a portfolio, if somebody's from Australia, a young person in Australia wanting to set up a portfolio, first thing I say to them is stick in the top 20 stocks in the Australian market. Suggesting to you, I don't know where you are, where you live. If you are in the US, stick to the top 20 stocks in the S&P 500 or the Dow, one of the two. Buy those for long term because they're the best stocks in the market, and they are so for a very, very good reason. But have a read of my book if you haven't seen it, Accelerate Your Wealth. It's at good bookstores, it's online, you can get it there as well throughout the US, and it'll help you understand how to construct a portfolio, what you need to do, how to find the stocks, how to protect your capital if things like we've seen the coronavirus happen, because I know I've had dozens and dozens and dozens of emails who people have read my book prior to what's happened in the last couple of weeks, thanking me for helping them get through this and giving them some strategies. But good luck with it, matey. That's just take it slowly, one stock at a time, buy good quality stocks. So let's get on to the next question. This one's from Ross B. He says, "Hi Dale, can you please have a look at Visa and MasterCard? I don't own either. Both had strong 2019 and have been sold off quite heavily." So let's have a look at Visa and MasterCard. I will put my glasses on for these so I can see a little bit there. Looking at Visa and MasterCard, you can see both have been beautiful bullish stocks. Visa has been a beautiful bullish stock, not super bullish, and that's one of the ones I was sort of suggesting earlier. This is one of the big stocks in the Dow, I believe. I'm trying to remember whether Visa's in there. I think it is. If not, it'll definitely be one of the top stocks in the S&P 500. But looking at this right now, it has been sold off. I wouldn't be buying into it right now either. It's, again, like I was saying to Jim, don't buy. Sit on your hands. And some people go, yeah, but if I can buy in right now, it's only $175, and if it gets back up to $200 there, we're making a bit of money here, and we're making 18-20%. So people are jumping in hoping to get that. That's a gambling mentality. I would rather lose all of this and not lose it, but not make that, to get in a stock that I know is going up strongly, because right now we could be catching falling knives. It's completely conceivable, but Visa and or MasterCard and other stocks will fall heavily again over the coming weeks and or couple of months to get a final washout. That is possible. So right now, stay right out of that. But let's have a quick look at MasterCard, and you'll see a little bit of a similar sort of scenario if I bring that up. You can see again, almost looks identical MasterCard to Visa, doesn't it? So if I've dragged that over, again, fallen heavily over the last few weeks after doing beautifully. So right now, again, I'd say exactly the same thing, Ross, as I said to anybody else at the moment. Now's the time to sit on your hands and do nothing. Now, whilst that may be frustrating for you, maybe you're trying to pick up a few bargains. As I mentioned to Jim, if you buy a bargain or what you perceive as a bargain, you may get more than you actually bargained for, and right now is not the time to get into any new stocks. So last question we got is from F. I'm not sure what your first name is, but F, Dale, she says, Dale, is it better to buy now or after Q1 or even Q2? I'm not sure what the next word is, DCAing, whatever that means. Dollar cost averaging. Don't ever dollar cost average, mate. It's the way to go broke. Is good in this uncertainty? No, dollar cost averaging is the worst thing you can do. Again, same reason. You could never buy something that's falling away. Never buy more of a stock that you're already losing money on, or you're losing money on if you're losing profit. Why would you do that? Because you don't know how deep the fall is going to be. So unless you understand that it's going to fall 10% or 20% or 30%, how do you know that you're getting it at a good price? So buying cheap is not the same in the stock market as it is in the supermarket or anywhere else. You know, people go to the supermarket and go 50% off. I'll buy that because it's cheap. I'll buy 2 of them because it's cheap. You can't value stocks like that. It's when you're valuing stocks, it's compared to what? And what I mean by that is, what is it worth compared to what the share price actually is for you? So you need to be careful. And buy now or after the Q1 or even Q2, I don't know. And it's seriously, I'm an expert at this, but I don't know right now. And when I don't know, and not that I'm saying that from me being nervous or being fearful of the market, I'm none of those. To me, I don't really give a rat's whether the market goes up or down from this point of view. All I care about is what I'm actually doing and the strategies that I have. So will I be buying after Q1? Possibly. Will I be buying before the end of Q1? Possibly. Will I be buying after Q2? Possibly. The market will tell me. And so there's a golden rule in trading the market is trade on confirmation, not speculation. Buy now is pure speculation. And that's really what I'm saying here. So just sit on your hands, take it easy, put your feet up, have a nice cup of tea, and everything will settle down, and then we can get back to some normality. And then if you've got good rules, you'll start profiting. Jumping early could see you have a lot of surprises that you don't actually need. So, but thanks for sending in your questions, and thanks for watching till the end of this video. Now, if you'd like me to answer any questions for you, just stick them below and I'll get to typing them. So there's a little chat box down below that you can stick it in. If you're one of those people that just likes putting negative comments on or putting some useless trivial rubbish on it, please just don't bother. It really isn't, unless you're going to put a good question on there, or you adding a constructive information for people to learn from. Just keep your opinions to yourself, because it really is not good to see people go out there putting negative stuff out everywhere, and it's not good for anybody. But if you do have a good question for me, please stick them in there. Remember, I do these reports every week, so hit that subscribe button now, and remember to click the bell on the right of it so you know when we go live with our latest stock market reports. But for now, I'm Dow Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.